This is the Illinois Farm Economic Summit, the 2021 version, a policy update for 2022. I'm University of Illinois Extension's Todd Gleason. Today, our panelists are Krista Swanson and Nick Paulson. We're glad to have them on board for the day. We do want to give you a quick review of what the topics for the day will be. There'll be a review of the last few years. We'll talk about the ARC and PLC program, crop insurance, infrastructure bill, the Buildback Better program, and look ahead, of course, to the 2023 Farm Bill. Nick Paulson is with us, ag economist here on the Urbana-Champaign campus of the University of Illinois. Nick, thank you for joining us today. As we get started, I do want to remind folks that we are underwritten in part by TIAA, the Center for Farmland Research, Compeer Financial, Corteva Agrisciences, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers Association, and the Illinois Soybean Association. Good morning to you, Nick. Thanks for being with us. The floor is yours now.
Yeah, thanks, Todd, as always, for the nice transition into the morning. Thank all the attendees for being here with us for this last session in the IFAS meetings, and Krista Swanson's with me this morning. This last session on policy was originally billed as being a team of three with Jonathan Kompas joining us. Unfortunately, Jonathan has been continued to be pulled into duty with his partial leave with the Senate Ag Committee. He sends his apologies, but is continuing to work diligently on big ag policy issues and trying to get some things done here with Congress before the new year. As Todd mentioned, this is just kind of a general outline here of some of the things we'll talk about. So I'm going to take us through on the front end here a review of the last few years, specifically looking at some of the government payments that have flown to agriculture. We'll briefly talk about 2022 thinking as it relates to ARC PLC or farm program decisions and the crop insurance program, although I would caveat that, and I'll say it again later, that we don't know a lot. Lots going to happen between now and when those 2022 decisions are made and the insurance sign-up period in early March. February is obviously a critical time for crop insurance. We'll see some, I'm sure, changes in what we see for price outlooks, but we'll talk a little bit about those things. Then I'm going to hand it over to Krista. She's going to go over what is in the infrastructure bill and point out some things related to impacts in ag. Also talk about Buildback Better, which we will emphasize is not officially passed or been signed into law yet. And thus changes could still occur, but we'll show you where it's at in terms of the House passed version that we have as of now. And then we'll wrap up and just kind of throw some things out there, more questions than answers about looking ahead to 2023, which is when we expect the next farm bill to be passed. All right, so to get started on kind of the review section, the figures provided here in this net income and government payment chart come from the most recent farm income forecast from USDA's Economic Research Service that was released on December 31st. So just some context for kind of where we're sitting in terms of the aggregate measures for the ag industry in the country as a whole. First thing to point out here is that USDA is projecting a near record income level for 2021. Falls short of being a record only to farm income in 2013, but approaching that $120 billion aggregate income level for 2021. As you can see, there is a fairly sizable chunk of that net farm income that is associated with direct government payments. A lot of that for 2021 is actually carryover from some of the ad hoc support associated with the pandemic, things like CFAP and PPP benefits that are being credited on a cash accounting basis, if you will, for 2021, but are really associated with previous years. If you were doing it on an accrual basis, we'd probably see some of that income in 2021 shift back to 2020 or even 2019, based on the years those payments are actually associated with versus when the cash flow actually showed up. The key point here on the government payment side is just the historically large share of income that is coming from these direct government payments in the past 3 years. In terms of the share of overall income, we're similar to, and even in 2020 exceeding the historically large shares of income that came from government payments back in the late 90s and the early 2000s. And one way that I would kind of contrast the payments that we've seen in the last 3 or 4 years to those that we had in the late 90s and early 2000s is back then the support was more equally distributed across the commodity programs in place at that time, along with some additional supplemental ad hoc assistance that occurred in those years. Since 2018, the support levels we've seen, the large support levels we've seen, have been very much more dominated by supplemental and ad hoc assistance, and a lot of that has been obviously associated with what are hopefully unprecedented events. So 2018 and 19, a chunk of that government support is coming from programs associated with some of the negative trade policy impacts through the MFP programs. And then in 2019, we had natural disasters and payments coming from the WIP and WIP Plus programs. And then obviously in 2020 and 2021, a lot of this is associated with pandemic assistance, both USDA programs like CFAP, but also some more general non-USDA pandemic assistance that supported other industries as well. The main one here being that's included here in the government payments from ERS is the benefits from the Paycheck Protection Program in terms of some of the forgivable loans that went through PPP. The other thing I would highlight on this chart is that the government payments that are reported here, the definition of direct government payments that go into these farm income figures, does not include crop insurance benefits. And so to kind of pull that in, since that's also such a major support area for ag, part of the overall safety net for ag, I pulled in data from RMA in addition to what is reported by the Economic Research Service. And so here we're looking at by program over the last 10 years, how some of those support dollars have flowed. So commodity programs in blue, conservation in green, and then adding in crop insurance as well here, which I'm just taking as net indemnities paid to farmers. So total indemnities minus the farmer paid portion of the premiums. And so if we look at this 10-year period, just under $5 billion on average coming from commodity programs, about $5 billion on average coming from crop insurance. Payments from the programs in both of those areas are relatively variable or volatile. That's by design. We now have a safety net. Crop insurance, by definition, is something that will have larger payments when conditions warrant. So low prices and or low yields, low revenues. Commodity programs now are designed much the same way, so that larger payments are triggered when we've got low prices or low revenues as well. Conservation, on the other hand, just under $4 billion a year on average, and a relatively stable annual outlay from that program, just based on the types of programs and their design that are in that conservation title area. So here's the traditional kind of standing farm bill programs over the last 10 years. And if we add in the supplemental and ad hoc side of things, this really illustrates just the large level of support that's come from those supplemental ad hoc programs in the last 4 years. So again, there's the averages for the standing programs, commodity, conservation, and crop insurance. And if we look at the last 4 years with supplemental, we've seen about $20 billion a year on average, $6 billion in 18, $15 billion in 19, $35 billion in 2020, and then $20 billion projected for 2021. Again, a lot of that's associated with losses, if you will, from the previous years, but the cash payment showed up in 2021. So you can see it's really illustrates here. We'd had to change the axis to even look at supplemental ad hoc compared to some of the other programs. And it's really been dominated the last few years by payments from those types of programs. So I think one of the big questions that this brings up when we kind of look at this historically is has what we've seen with ad hoc in the last few years, does that kind of challenge the design or adequacy of some of those standing programs, commodity programs, crop insurance? When the crop insurance program was really started to be bolstered in the 80s, and growth really took off in the 90s with introduction of revenue insurance products. One of the long-standing justifications for subsidized crop insurance for farmers is it should be able to reduce the need for supplemental ad hoc assistance that we've seen in the last 4 years. So is the fact that we've had to have these large payments the last 4 years from those types of programs, does that kind of question the adequacy of things like crop insurance that are standing programs? Or, did we just experience some kind of unprecedented black swan events with the trade war and then the pandemic right after that? Arguably a lot of this support was needed. It was based on calculations at the time of what some of the losses associated with those events were. And it's hard to think of a standing program like crop insurance or having a commodity program in place that could possibly be designed to cover those types of hopefully, again, black swan events that we don't anticipate to occur consistently over time. I think there's also a question out there, definitely some public opinion out there that maybe too many dollars flew to agriculture over the last few years, or at least that perception has been created, particularly with some of the relatively strong income levels that have been experienced with the rise in commodity prices over the last year. So I think these are all just issues we have to think about, how perceptions, realities impact the policy process, the politics, moving forward as we look to continued changes with the 2023 Farm Bill or other programs, or even further down the road. This last government payment slide, again, just gives another look. It lumps all of those programs together that were in the previous two slides, just to give a measure of total support, which also does include crop insurance here. So, again, over $30 billion in 2021, $50 billion in 2020, almost $30 billion in 2019. I think there are some important questions about what that creates in terms of public perception about the support flowing to agriculture, what's needed. The support levels we've seen the last 3 years are larger even than what we saw flow to ag during the major drought of 2012. And they're really only rivaled by, again, some of those support levels that we saw during the late 90s and early 2000s, when we had an extended period of very low commodity prices, triggering payments and creating the need for some ad hoc assistance in those years. So that's kind of the national kind of aggregate picture. I think a lot of the ways in which, particularly people at the federal level in Washington, tend to look at things. Also wanted to give kind of a more localized look, particularly going into 2022. Also wanted to highlight the fact that Gary Schnicke updated the crop budgets for Illinois for both 2021 projections and going into next year with 2022 projections. So this was published, I believe, just this Tuesday, December 7th, in FarmDoc Daily. So a couple of points to make here on the Illinois specific side of things. Record return levels projected for 2021. Higher than even the returns that were experienced at kind of the height of the ethanol and export boom in the late 2000s, early 2010s. That is being driven by strong commodity prices, budgeted prices for 2022, as well as the prices that we think are going to hold for what the 2021 crop is marketed at. And then looking ahead to 2022, again, continued relatively strong corn and soybean prices, $5 on corn, $12 on soybeans in our 2022 budgets, resulting in positive, decent, not great, not terrible return projections for both corn and soybeans, and very comparable return levels. So there's been a lot of speculation, a lot of talk about, given where we've seen input costs go to, particularly on the fertilizer side of things, are we going to see some big acreage shifts? Right now, what the market is signaling and what these budgets indicate is that there's not a lot of reason to think or a lot of incentive to see big acreage shifts in 2022, at least based on projections here for Illinois. I mentioned the input cost side of things. I think that's a big question going into 2022. Are we going to continue to see these skyrocketing fertilizer prices through the spring? We're expecting a big increase in pesticide and a pretty moderate to normal increase in seed prices continue into 2022. Also expecting land costs to increase, cash rent levels to increase in 2022 relative to 2021. And so again, I think it raises the question, even though we've got crop insurance, we've got commodity programs, given their design, are we going to get into a situation next year where if prices come down from where we currently think they're going to be, and if we see input costs continue to rise, are we going to be in a position again in 2022 where there's calls for additional ad hoc support, and what is going to be the political appetite to even consider those types of things, given what has occurred on the ad hoc and supplemental side in the last few years. So that kind of segues into thinking about the standing programs in 2022. Obviously, we'll have crop insurance signups as usual in the first couple weeks of March after the price discovery period in February. On the crop insurance side, those no major policy changes, no new major policies going to be introduced. Kind of the same suite of farm level yield and revenue products are going to be available. Some of the newer supplemental products will continue to be available that were introduced as part of the 2018 Farm Bill. Those will continue to be available. Probably the newest changes or maybe relatively minor modifications to crop insurance are going to come on the endorsement side. So some rule changes, some things associated with cover crop practices and how they impact crop insurance coverage. Also, an endorsement has been announced, has not been finalized yet, but an endorsement's coming for 2022 associated with some additional coverage for split application nitrogen practices. On the farm program side of things, so the ARC PLC decision, again, this is now an annual decision. So whatever your farms were enrolled in 2021, those can be changed and updated for 2022 by the March deadline. The table there shows what the effective reference prices will be for corn, soybeans, and wheat. It also shows what the 2022 ARC benchmark prices will be. As you can see, for corn and wheat, they're both $370 and $550 across the program. Soybeans still has a slightly higher ARC benchmark price than the reference price for PLC. But given where market prices are currently at, where futures prices are currently at for 2022 contracts, not a big expectation for any sizable payments from either ARC PLC program in 2022. Obviously, things can change between now and the end of the 2022 marketing year, which won't even begin until next August or next September for corn and beans. But all indications right now are that ARC and PLC will probably not be super relevant programs, and the decision, is probably not an obvious one across either choice for any of the three main crops here for Illinois. So again, what's the likelihood of more ad hoc in 2022 if we see prices fall from where they're currently at, or if we continue to see input costs rise? I could easily see a situation play out where we could see some price declines between now and the insurance price discovery period in February. So there could be the argument that crop insurance isn't providing meaningful revenue guarantees relative to what a lot of the inputs were locked in at on the price side. And then again, with ARC and PLC, it probably not going to provide big support payments next year. It would take some pretty sizable yield losses or some pretty sizable price declines from current expectations for those programs to become too relevant for 2022 support. All that being said, we're still a long way from making decisions related to farm programs, ARC PLC, and crop insurance for 2022. We'll be providing a lot more info to help guide those decisions. Obviously, after the new year, we'll do our regular education programs leading into that March sign up and enrollment period. Do want to remind everybody that we will continue to have our decision support tools out there to support those decisions. So whether that's the ARC PLC calculator for that decision, or the crop insurance tools that we have out there to take a look at what premiums will be for 2022 and evaluate the expected payments associated with the different policies. All those things will be updated and ready to go once we get into late winter, early spring to support those decisions. So I want to recognize the Gardener program and NCSA and all the help and support that continue to go into making those available for our farmer stakeholders. With that, I'm going to turn it over back to Todd, and he'll segue into Krista, who's going to talk with us this morning about infrastructure and Build Back Better.
In fact, Krista Swanson is here. She'll be with us in a moment. We do have a poll that we would like you to fill out. So go ahead and pull the poll up. And I will take a quick question that was asked about those projections for 2022. From Gary Schnitke that was asked. Go ahead and fill the poll out and I'll bring you up to speed on those projections. Those numbers are for, and it was about the yields. They are 225 for corn and 71 for soybeans. Those are not statewide. Those are for central Illinois high productivity soils. So just so you know where those are coming from. And we'll take a look at the poll too. Go ahead and fill this out real quick. What best describes your opinion of the infrastructure bill? Needs to be done, should be spending more, needs to be done, spending's about right, not necessary, but there are worse ways to spend public dollars. And too much spending, major concerns about the deficit, no opinion. You just don't know that much about it. So take some moment and fill that out, and we'll get the poll up when we get about 70% of you filling it out. We're getting close at this point. People like to know how many are on just to get an idea. And there is a difference between the number of people that have filled out the poll, relatively speaking. So around 230 of you are on. We'll get to about 70% here momentarily. And we'll see what your poll answers are. And then Krista Swanson will give her review of what she thought the poll answer should be. Go ahead and pull the answers up to that. Looks like 37% say too much spending, major concerns about the deficit. However, the first two categories added together are 49% needs to be done. And needs to be done. Either the spending should be a bit more or it's about right. So let's see what Krista Swanson has to say about those as answers. Hey, Krista, thank you for being here this morning. We sure do appreciate that. Good morning to you, by the way.
Good morning, and thanks. I'm glad to be on. Yeah, so the poll responses, I'd say that that's maybe about what I would have expected. I think that a lot of farmers are probably caught between that understanding of the situation that we had in some of our transportation pathways, but maybe also having that concern about the deficit as well. So kind of seeing it split between those two kind of groups doesn't surprise me. So what is in the infrastructure bill? So formally, it's the Infrastructure Investment and Jobs Act. It's also commonly referred to as the Bipartisan Infrastructure Framework Bill, or abbreviated or acronym by BIF. So in this bill, there's not really much in the way of farm aid, direct farm aid, but the aim of the provisions in the bill is to revitalize rural areas and improve transportation systems, which is, of course, important to those of us in agriculture. We all know how important our transportation pathways are, not only in getting the commodities that we produce to their next destination, but also the inputs that we need to produce our agricultural commodities, getting those into where they need to go as well. So this was a $1.2 trillion plan, and it was signed into law on November 15th. And about half, a little over half of that 1.2 trillion, 650 billion of that, was pre-allotted funding for highways and other scheduled projects. And then a little under half, 550 billion, was new spending. And that new spending was the projects within the new spending can be categorized into two groups. About 52% was for surface transportation projects. So this would include things like roads and bridges and railways, public transit, ports and waterways, airports, among other things that fit into that category. But those are some of the really big ones. And then about 48% is core infrastructure projects. These are things like energy and power and broadband, water systems, Western water situation. So out west, this is a bigger deal for farmers in the Western region of the United States than it is for us here in the Midwest. But there's a lot of, they have issues with water shortages and water storage there. And there was actually a chunk of money in this bill that was dedicated specifically to that region. So that's good news for farmers in those areas. And then some environmental remediation projects. Those are the types of things that are part of that core infrastructure group. So that kind of gives you an idea of how this new spending is being split up. And then I wanted to highlight a few of the things here on the next slide that are maybe of higher importance. This, of course, doesn't cover everything. I'm not going to go through everything in this bill, but I picked a few of the things that I thought were maybe of higher importance to ag and rural communities. So, of course, like I mentioned earlier, improving that ag transportation network is definitely important. There are a lot of roads and bridges that are in need of major repairs and replacements, and this funding does, the funding for that includes those types of projects. $110 billion was allocated to roads and bridges, and that's 10%, about 10% of the entire bill. So that is a huge amount going to those pathways. And then railways were allocated 66 billion, and ports and waterways 17 billion. So you can see the amount of money going to those pathways that I already talked about, being so important to agriculture. Another interesting provision related to what I'm calling the Ag Transportation Network is a provision to exclude livestock haulers from normal trucking hour limitations if they're within 150 miles of their destination. So I guess we know that there's a trucker shortage right now, or maybe a shortage of truckers to keep all the transportation needs moving. And for those who are livestock farmers, this is an important provision related to transportation as well. Another kind of category important to ag and rural communities is addressing the digital divide. So some rural areas are really lucky to have good internet connection, but a lot of the rural areas across the United States don't have sufficient connectivity, or at least not at an affordable price. And so there's $65 billion in this bill that's put towards expanding broadband connectivity and affordability. And that's particularly targeted towards those areas that don't have access or have poor access now. I thought interesting too is 47 billion towards protecting against cybersecurity threats. There have been some agricultural companies that have dealt with such threats, and I think we can all understand how significant that could be to the industry if a large agricultural company or organization was targeted by a threat. We've seen what's happened with those in some other industries. So that's kind of an interesting allocation of that money. And then strengthening the electric power grid, which is important to everyone, but definitely benefits rural areas as well. Another category is enhancing water systems. I already went into a little bit of detail on that, explaining how some of those funds were specifically for the western region of the United States, but overall, it's working to improve national water systems. The water infrastructure throughout the country is aging and is in need of repair, and so this would work to address that. It would also provide some new water storage and groundwater storage capabilities and provide some funds for USDA's watershed programs. And then the other thing I wanted to highlight is the expectation of the created job opportunities throughout rural America. Moody's put out a study on this where they estimated that at the peak impact of this bill, which the funding extends over a 10-year period, we would see over $800,000 jobs created at that peak impact point. So that concludes what I was going to talk about related to infrastructure. And now we're going to switch gears a little bit to talk about Build Back Better, which is notably different from that bipartisan infrastructure framework that we already talked about. So unlike the infrastructure, which is already signed into law, Build Back Better is still making its way through Congress. So what I'm talking about today is kind of a reflection of what's proposed or passed by the House. The House has passed a version of this bill, but the Senate is still debating and doesn't have their text available yet if they're assuming that they're making changes. So this bill actually started out at a $3.5 trillion bill, and it is now, the version that the House passed was a $1.75 trillion bill. So you can see that it has already changed significantly from where we started. I would say that more changes are likely, or at the very least, more changes are possible as it goes through the Senate. I know there's a few senators that have, a few of the Democratic senators that have concerns about, some things that they still would like to see changed in this bill before they're willing to vote on it. And those votes are going to be necessary to make its way through the Senate. So some elements of this reconciliation package would benefit agriculture, but this is a spending and taxation bill. So taxation is also part of this deal. And I called it the reconciliation package there. So I want to note that this Build Back Better bill is sometimes also referred to as the reconciliation bill or reconciliation package, which is kind of a reference to the process through which it's getting passed as it moves through Congress. So both of those are referring to this Build Back Better bill. So within Build Back Better, there is a $27 billion allocated to climate smart agriculture. And this is really significant because it's the biggest investment in conservation since the Dust Bowl back in the 1930s. So we're talking about 90-ish years of the biggest investment in that time is a really big deal. We had a question actually come in from ahead of time that someone was asking for farmland owners, are there any farm program benefits related to cover crops in new legislation? So this will be of interest to the person who asked that. There is $5 billion for soil conservation assistance related to establishment of cover crops for soil health. And this would entail payments of $25 per acre to producers who are doing cover crops, and that would be available on up to 1,000 acres. And there's also $5 per acre for non-farming landowners who are allowing their rental farmer to do cover crops on their land, again, for up to 1,000 acres. So there's a program or some funding in here that provides some direct farm aid for producers who are doing that practice. Another part of this conservation spending is $200 million related to conservation technical assistance, $50 million for climate change adaptation and mitigation activities, and $600 million for NRCS to facilitate a new carbon sequestration and greenhouse gas emissions qualification program. And from the name of that, it almost sounds to me like it could potentially be a program that makes payments. I did a little digging. I know that there's so much interest right now in what's coming related to, carbon sequestration or payments for such. But I couldn't really find out any more. The most detail I found was that it has to do related to collecting farm and ranch data. So that'll be maybe something to watch. That might be another area where there might, I don't know if that includes some funding for farmers or not as we move forward. So also included in that conservation funding are additional funds to existing conservation programs. So we have a number of different conservation programs that funding is provided for through the Farm Bill. Conservation Stewardship Program, which is commonly called CSP, is shown by the blue in this graph. And Environmental Quality Incentives Program is shown in the orange. That's also referred to as EQIP. We also have the Agricultural Conservation Easement Program in green and the Regional Conservation Partnership Program in red. So the solid bars going from 2020 to 2031 for each of these programs are the projected outlays that Congressional Budget Office included in their USDA baseline projections from their most recent publication in July of 2021. And so you can see the amount of expected outlays for each of those programs in each year, again, represented by those solid bars. So Build Back Better, again, includes some allocations for additional funds to these programs that already exist. And those Build Back Better additional funds are shown by the striped bars on top of the solid bars. And that funding would go from 2022 through 2026. And you can see that particularly in the years 2024, 25, 26, that additional funding is quite significant, especially considered to the funds available, projected available for that programs in those years. It's really adding a lot of money to those programs to provide more opportunities, make those programs more accessible, expand that opportunity for farmers to do qualifying conservation practices and have the ability to get some funding to support those conservation practices through those. I guess most notably that funding for EQIP in those 3 years of 2024 through 2026, it more than doubles, well, almost doubles in 2024 and more than doubles existing funding for that program or in those 2 years, 2025 and 2026. Another inclusion in Build Back Better are some ag credit provisions related to assistance for farm loan borrowers. So some of you may remember that the American Rescue Plan included $6 billion of debt relief for farmers of color, but there was some challenges to that in the courts earlier this year, and it was kind of put on hold for a period. So what Build Back Better does is it diverts that $6 billion from the American Rescue Plan and adds another $6 billion to provide $12 billion to support new and existing farmers that have farm loans with FSA through outreach and education, technical assistance, and payments to farmers. So there would be funding to provide payments to economically distressed borrowers to offset their farm debt with FSA. There would also be some possibility for loan modifications for borrowers who are at risk, considered to be at risk. Another interesting provision related to this is that even farmers who do not fall into one of those qualifying categories, meaning being qualified as an economically distressed borrower or an at-risk borrower, all other FSA borrowers are actually eligible for up to $150,000 to counter their FSA debts. And again, just want to know that this is as it's this legislation is still pending right now, but this is one of the provisions in it. And one thing to note, though, is that payment would be reduced by the total amount the borrower received from MFP payments and CFAP payments going back to 2018, the total sum. So if you're a farmer with funds borrowed through an FSA loan program, you could kind of calculate maybe what you would be eligible for by adding up all that you've received from MFP and CFAP since 2018. If that value is under 150,000, if this passes like this, you could be eligible for that difference. A few other items of interest in this bill of agricultural interest are funding for various agricultural research initiatives. There's funding to help rural communities in a number of ways, like modernizing water, food, and electric systems, forestry programs, biofuels infrastructure investments. I do want to note, I've seen some misinformation going around about the methane tax that's in Buildback Better. So there is a methane fee outlined in Buildback Better that applies to petroleum and natural gas systems and not to the agricultural industry. So I've seen a few videos being shared on social media that talk about a methane tax on livestock. I wanted to clarify that is not included in the bill as written. There have been a lot of people expressing their desire to do that, though. So it's definitely something to watch and stay diligent on as far as communicating with your ag organizations and legislators on your feelings on that, because there's nothing stopping it from being included in a future bill. So as I mentioned earlier, this is a spending and taxation bill. So we've talked through some of the ways that spending could benefit farmers as it's included in this, but there is a taxation side as well. So there are some positives in this proposed tax legislation as compared to some of the proposals we saw flying around earlier in the year, such as elimination of automatic step-up in basis, or a new transfer tax, or limitations on 1031 like-kind exchanges. All of those are not included in this legislation that has passed the House and is being debated in the Senate. Some of the things related to taxes that are included are a change in the ordinary income top tax bracket, an increase in the highest long-term capital gains tax rate, an expansion of net investment income tax. And of course, that's not the full list, but some of the things that might have the greatest impact on farmers I wanted to throw out there. I was a presenter on a farmdoc webinar on October 21st, along with Bob Ray and Brad Zwilling with FBFM. That is in the farmdoc webinar archive, and the three of us go into a lot more detail on what to expect from proposed taxation, and we go through a pretty thorough, some examples in there too. So that would be a great resource if you want more on what's included in taxation. And that is dated a little bit now, but as far as the taxation piece related to this, that hasn't changed as that bill has continued to move through. One thing, another set of changes, and this is one of the examples that we go through in detail in that webinar. But something to keep an eye on is that another thing that Buildback Better does is lower the federal estate tax exemption level. And then separately, it makes a change to this Section 2032A special use valuation. And in the interest of time today, I'm not going to explain a lot what that is. But the combination of these two moves, the two changes to these two things, is really interesting because it's sort of giving owners the option to pay for a step up in basis, similar to what the transfer tax that was proposed earlier this year was doing. Of course, it's starting at a higher level than what the transfer tax would have started at, but that's definitely something to watch. And if you are interested and missed that webinar, again, October 21st. And the point here is when it comes to any special provisions, you can expect calculations, caveats, and consequences. And so something to keep up with your accountant and your tax professional to find out how some of these proposed changes might impact you and your farm specifically. And so with that, I am going to turn it back over to Todd. We have another poll question coming up.
Yes, we do, and we'll look ahead when you and Nick come back. But let's start with this poll question. What Farm Bill program would you prioritize the most for more funds in 2023? So you'll be choosing one. The commodity programs, which are ARC and PLC, crop insurance, which is out of a different line item, conservation, nutrition, or something else. So go ahead and fill that out. I will remind you at this point that when you leave the webinar, whenever that happens today, there are some additional questions or a new set of questions. So if you're in the habit and been here for the last set of IFAS webinars and haven't been filling out this survey as you leave because the question's been the same, stop. Make sure that you fill out today's. We're looking forward to next year, and we want to know what you think about the upcoming potential for these webinars and what things we should cover. So make sure you fill that survey out as you leave today. Don't leave yet, though, because we're not quite done. We're still filling this poll out. What Farm Bill programs would you prioritize the most for funds in 2023? Again, commodity programs like ARC and PLC, the crop insurance, conservation, nutrition, or other programs. We're all ready to go here. So most have said, and this isn't much of a surprise, 37%, at least to me anyway, have said crop insurance. Conservation over the commodity programs is an interesting function, I think. Nick Paulson, what do you think of this? And were there questions that you saw that you want to answer as well?
Yeah, we'll get to a few questions, Todd. Yeah, on the poll, I think this largely lines up with what I would have expected. Crop insurance is what I would have guessed would have been the most likely number one category here. Maybe a little bit surprising that conservation was as far ahead of commodity programs as it is, but I think it just speaks to kind of the way that the wind is blowing in agriculture, and probably kind of an understanding that that's the focus of a lot of the support that's at least more maybe politically palatable, part of bigger conversations in the country and the world right now about things that we need to do, and so on that conservation side, I think is an area where support can be more justified, and opportunities for ag to kind of contribute to some of those bigger global issues. So here at the end, we just want to kind of throw out, again, like I said, maybe more things to think about, definitely more questions than answers from us. Interesting to see anybody's comments or questions as they type them in there as we wrap up. But I think the big issues going into what's expected to be the 2023 Farm Bill process. First big one is, with the midterms coming up, which party will end up controlling one or both chambers of Congress? That's going to be a big issue. I think regardless of the outcome there, another big question specifically related to the Farm Bill is, will the Farm Bill continue to be bipartisan, given the fact that we're living in a increasingly politically polarized country and world? Is this kind of traditional urban-rural coalition that we've had in place to help us get this new legislation or updated legislation every 5 years we've seen some tensions and some stresses to that, and in some of the last few farm bills. 2018 was kind of an exception, passed, I think, with by record margin, but some of the farm bills prior to that were a little bit more difficult. And so that's a question going in. Again, it'd be good if we had our friend Jonathan Coppice with us to talk about the baseline game, because his experience in DC makes him understand that a lot better than those of us who haven't been as involved with the process. But there is a baseline associated with the Farm Bill, and so typically any changes to programs that would affect how much those programs might cost is going to require some juggling across titles. So what's going to be the impact of Build Back Better if that eventually does get passed and signed into law? Is some of those top-ups to conservation programs, for example, are they going to impact baseline? If there is a desire to shift funding out of some areas into others, what's that allocation shift going to look like? And then again, related to our poll results, I think these questions about the rise of the importance of ad hoc support in the last few years, maybe we're harping on that too much. Again, maybe the last 4 years are just that unique, and we'll get back to something more normal where crop insurance, conservation, and commodity programs kind of service the needs. But between the importance of ad hoc and the rise of conservation, what kinds of implications do we see moving forward for what programs like ARC and PLC look like in the commodity title? What kind of implications do we see for crop insurance? I think we're already seeing, more conservation focused things creep into crop insurance. On the commodity program side, are we going to see any major changes there? Are we going to see maybe reduction in focus on commodity programs to bolster the crop insurance and conservation areas? I think these are all going to be part of the farm bill debate as we get later into 2022 and 2023. So just to summarize, again, from the early part of the presentation, I was just kind of trying to provide a little bit of perspective, maybe what outsiders, people at the federal level, people outside of agriculture, what they might see or perceive some of the farm income and government payment numbers, particularly in recent years, what those perceptions create in terms of political implications moving forward. For 2022, we've got the positive return outlook right now, but I think a lot of uncertainty, both on the output price side, the input price side, that I think the downside risk, is always a concern, but I think probably an even greater concern going into 2022. We've had major government spending, particularly since the pandemic, not just for agriculture, but major spending in general. Some of the implications of that associated with inflation. We got the inflation report this morning that it's the highest it's been since the 80s. So all of these things are going to impact policy moving forward, and including what we see on the farm policy front. And then I made the point on the previous slide about political polarization and how that might creep in and affect farm policy, which is something that has been relatively immune to that historically. So those are our summary points. I think now we can open it up for questions. We do have a few questions, but I'll kick it back to Todd to kind of do some more wrap-up stuff.
Yeah, so why don't you take a look at those questions? Think about this one as well. I'm wondering, you mentioned creep within the programs, particularly the programs that is the most popular with farmers, the crop insurance program, of creep of some other things like conservation into those, and whether that might become an issue in the future related actuarially or some other form if crop insurance is carrying along with those. And while you take a look at the rest of the questions and think of that, I will remind folks that if they're leaving, make sure they fill out the survey today. We do look forward to next year and ask you some questions about how we should move forward with webinars and other issues. So it's changed from what you've seen in the surveys before. We'd like to thank our sponsors as well today. They include the TIA Center for Farmland Research right here in the College of ACES, Compere Financial, Corteva Agrisciences, Farm Credit Illinois, the Illinois Corn Growers, Growmark, and the Illinois Soybean Association, along with our educational partners, which include the College of Agricultural, Consumer, and Environmental Sciences, the Department of Agricultural and Consumer Economics, as well as University of Illinois Extension, and FBFM. And if you bring up that last slide, you'll remember I talked about YouTube early on. There is a way that you can catch the archive of this. If you'd like, you can do that easily at youtube.com/farmdoc video. Jim Baltz, who's behind the scenes, moves these to that YouTube channel really quickly, and you can catch them there. Of course, if you want to see the full archive of the IFAS and the rest of the programs, be able to get hold of the PowerPoints and such, you can do that on the FarmDoc Daily website at farmdocdaily.illinois.edu. Look in the webinar archives section. It's quick and simple and easy to do. I think we do have some questions that both you, Paul, Nick, and Krista can answer for us before we wrap things up today. What did you find?
Yeah, so I'm actually gonna. Krista's not in studio, so I'm gonna I'll read the question to you, Krista, and maybe I'll give the answer that I think is right, but you probably need to correct me because it's on your section. So we had a question about how the Build Back Better funds, how you got to 27 billion on conservation with only 5 billion for soil conservation. And I think that's maybe just a bit of a confusion about maybe some of the dollar amounts you mentioned in the early slide versus what was in the figure in terms of topping up some of the existing programs in conservation. Does that question make sense?
Yeah, so I didn't talk through everything that's part of that 27 billion. So the 27 billion is the total allocated for climate smart agricultural practices. And I just mentioned a few of the things that are part of that I thought might be of the most interest given the time we had. And then also, I didn't mention the amounts. We looked at the graph, but I didn't say the amounts. But what's not included on that slide with the 27 billion is also all the funds going to those 4 programs I talked about. So if you add up some of that, that's also part of that 27 billion. But I didn't intend, I just covered a few of the things that are part of that.
Sure. Another question on the loan aspect of Build Back Better. So would a loan written by a local bank but backed by FSA be eligible for forgiveness? Do we know? It's probably a question we don't know yet based on the legislative text. That would come at implementation time. But any response on that question?
Yeah, it's talking about FSA loan debts. So that's Nick's answer is better than my rambling, but I think the short answer is we don't know yet. But the way that it's worded to me comes across as it's applicable to debts held at FSA. There's no mention of whether it's a guaranteed loan, as in part of it's also at a bank, but definitely something to watch for more information, assuming that this passes.
Sure. Got a question about how many farmers, some of those, the big ad hoc and supplemental payments that were in some of those early figures, how many farmers actually received those versus all, the entire population of farmers in the country. I think partial answer to that question is USDA has provided a dashboard that has kind of done some accounting for the ad hoc programs and where those payments have flown, at a commodity level. So corn farmers versus soybean farmers, not that those are different individuals, but money that's flowed to the different commodities, money that's flowed to different states. I'm sure there is some analysis that will come out. Just that's the nature of programs like that. It is public data. So I'm sure at some point, some people will kind of have estimates of, how many farmers actually receive CFAP dollars or what percentage of farmers received, this share of the dollars versus those that didn't receive it. I don't have any of those figures off the top of my head. Apologize for that. But another question on, what's included in some of those supplemental ad hocs prior to 2018. Basically, any ad hoc assistance is what that category is capturing. In some of the years just prior to 2018, it would include payments from the now defunct SURE program, the disaster assistance program that was created in the 2008 Farm Bill, if I remember correctly, but has since been ended. Some other programs going further back that, again, I probably can't remember the names or acronyms of now, but there's been a history of different types of ad hoc and supplemental programs over the years. I think the last thing I'll just wrap up with, because we're just right on approaching 12 o'clock. Todd made the comment about my comment about conservation even creeping into crop insurance. I think one point that maybe is important to consider is thus far conservation efforts, the approach to incentivizing, the adoption of cover crops or the adoption of soil conservation practices, no-till, other ways to sequester carbon. The approach thus far for agriculture has been very much a carrot approach rather than a stick approach, meaning that rather than regulating farmers, there have been pretty big efforts to create voluntary programs that just provide the financial incentives for farmers to make the choices to opt into those. I do think there will be, that'll be the continued direction we go in. On the crop insurance side, it already is impacting underwriting. I mean, it already is impacting how the program is designed with some of the conservation-focused policy endorsements and the premium adjustments that are made when farmers elect those. So I think we'll continue to see that more and more over time. With that, Jim is reminding me we are at 12 o'clock. He likes to be promptly on time. So I want to thank everybody for being here. Todd, do you want to take us out?
Yeah, thank you so much. Thanks to Jim Baltz, who's been behind the scenes. He'll make sure everything's up online at farmdocdaily.illinois.edu. Check out the archive when you get the opportunity. Our thanks to Krista Swanson and Nick Paulson for joining us for this policy update for 2022. It's part of the Illinois Farm Economics Summit for the 2021 year. Again, we thank you for being with us, and do fill out the surveys. I'm University of Illinois Extension's Todd Gleason.